The financial system is cracking and it's getting even worse. SOFR spreads just hit a record 5-year high, now at the highest level since March of 2020 when the basis trade imploded. And banks are rushing back to the Fed's emergency liquidity backstop yet again, this time for the highest non-quarter end use in over 5 years. Could this unwind the massive $1.2 trillion basis trade? And if so, what might it look like? SOFR came in for yesterday. It is getting even worse. As we can see, SOFR is now 31 basis points above the reverse repo award rate. And again, not only that, but the Fed funds, the unsecured side, has been moving higher as well, despite the fact the Fed has actually been cutting interest rates last month. And of course, again, today, the Fed is expected to cut interest rates. We actually have a 4 basis point increase in the Fed funds. So remember, the Fed funds, much smaller overnight market, that is unsecured. SOFR is secured, much larger, about $3 trillion per day. So we were at a yellow light. We've been warning about this coming for 2 or 3 months. We were at a yellow light. And then the past couple weeks, you could argue it was an orange light. We are starting to become at a red light. And I'm not the only one that is saying that. Here are a number of other folks that are claiming that this is starting to become a real crisis. So again, not only do we have a blowout in SOFR spreads, but we also have an increasingly frequent usage of the Fed's standing repo facility. This is again where the financial firm goes to the Fed and says, I desperately need cash. Here are some US Treasuries, give me cash. And as a short-term loan with, of course, an interest rate, we can see an increasingly frequent usage of the Fed's emergency liquidity backstop. In fact, it is the highest non-quarter end use that we got just in this morning, the highest non-quarter end use of the SRF going back over 5 years. So not only is SOFR blowing out to levels not seen since March of 2020 when the basis trade blew up the first time, but we are also seeing the SRF being tapped to an increasingly frequent degree. And not only that, but it is not quarter end. So here are various quarter end dates. Now, quarter end with window dressing, of course, liquidity becomes much more scarce as well, and is normal to see SOFR start to move in an elevated fashion above, say, IORB or the reverse repo, but we are not at quarter end. And again, tax deadline was another sort of typical liquidity strain back in mid-September. It is not tax deadline. It is not quarter end. It is not even month end. So the data we got for SOFR was from yesterday. We still have another couple days until the end of the month. So not only is SOFR blowing out, the Fed funds is starting to increase. And not only that, the standing repo is starting to get tapped, that Fed emergency liquidity backstop. And again, not only that, but it is not quarter end. So here we can see SOFR above the discount window rate. So anytime SOFR is above the discount window rate, we see a white line and it's a baseline chart. So anytime SOFR is below the discount window rate, of course, it's orange. That is typical. So again, remember, the discount window rate is the Fed's attempt at setting a ceiling in the overnight cost of capital, in the price of a dollar. Right now is at 4.25. That is the Fed's way of setting a ceiling in the price of money in these overnight repo markets. Now, remember, the reverse repo award rate, that is the Fed's way of setting a floor in the price of money. The reverse repo, no matter how overabundant dollars get, the Fed is saying with the reverse repo, we will always buy them from you at 4%. The discount window rate is the exact opposite. That is the Fed saying, no matter how scarce dollars get, we will always sell them at 4.25. And by doing that, they are trying to set a corridor. And I had mentioned yesterday that if we saw SOFR above the discount window rate in an elevated fashion or for a prolonged period of time, it would indicate that the Fed is losing control over the overnight cost of capital. And again, not only that, not only is SOFR above the discount window rate, but the standing repo is getting tapped to an increasingly frequent degree. Now, the discount window, it's important to note there's significant stigma associated with using the discount window. I will link this article in the description. It is from Liberty Street Economics, the Federal Reserve Bank of New York. I will link that in the description, which talks about the stigma associated. But as we can see, this is the first time that the SOFR rate is above that upper bound that is not quarter end, going all the way back to March of 2020. Now, by the way, for those that really are curious about this, here's the data for the various percentiles of SOFR. Remember, what we're looking at is a volume weighted median, and that shows the actual distribution here if you are curious. And I also had AI provide a compare and contrast for the standing repo versus the discount window. If you are curious about that, you can pause the video there and take a read on that. But you can think of SOFR as the actual cost of capital, the actual supply and demand dynamics of cash relative to collateral, or put another way, cash relative to available cash willing to be lent out. Many commenters on recent videos have commented there might not be a liquidity shortage, but if there's significant concern about counterparty risk, we know, of course, First Brands and Tricolor, some of the regional bank issues. If there is concern about counterparty risk, there might be a hesitance to lend in the SOFR market. So, of course, that removes cash on the supply side that is available and willing to be lent out, which contributes to a scarcity and therefore an elevated SOFR interest rate. And again, 4.31, that is now 6 basis points above the discount window rate. And again, it is not quarter end. So normally it is normal to see some amount of elevated strain in liquidity markets, in the funding markets at quarter end. And I also put on tax deadline as well. And as we can see, the standing repo got tapped for $10 billion today. I will show you that here, and I will also link it in the description. $10.2 billion Wednesday, October 29th. And again, as the Fed chart here shows, this is very, very, very rare, especially outside of quarter end. So we are certainly in an elevated strain here, an elevated liquidity crunch that could become quite severe quite quickly. Of course, repo rate crisis here. The SOFR went about 900 basis points above the Fed funds. Imagine the impact of a 25, 50 basis point interest rate hike. Now imagine a 900 basis point interest rate hike. So that is what happened back in 2019. And the Fed's response was to print dollars out of thin air, inject those into the system. Of course, here we can see bank reserves are inversely correlated, at least recently, to the SOFR spread, as bank reserves have been dwindling from about 3.4 trillion down to 2.9 trillion. We can see that has coincided with an elevated SOFR spread. And again, this is due to why liquidity is tightening. So the Fed's engaged in quantitative tightening. As we can see, the balance sheet has been decreasing. Not only that, but the reverse repo, which is the Fed's buffer or shock absorber for liquidity strains, that is empty. And not only that, but the Treasury General account has been being built up due to some massive Treasury bill auctions. We're normally seeing $110 billion auctions. And again, when the Treasury sells a Treasury bill, what they are doing, someone is providing the Treasury in cash, dollar liquidity. The Treasury gets dollars, someone else gets a security. So again, that is removing cash from the system. And we can see the TGA, the government's checking account, has been built up by about $600 billion. And again, that can't come from the reverse repo because that is empty. That buffer, that storage tank for excess dollars is empty, and therefore it must come from bank reserves. Again, bank reserves being half of the M0 or the monetary base, and of course down to 2.9 trillion. I also threw on here the 9-week rate of change of government debt. We are, of course, running massive fiscal deficits, and of course they were also trying to build up the TGA. So we have a huge amount of debt being issued every single day, every single week, every single month. And as we can see, huge spikes in the rate of change of the government debt, the underlying government debt, do coincide to a decrease in bank reserves. Now, the basis trade unwind. Of course, we just did a video. I will link it at the end of the basis trade, how it is funded, how it actually works. It's in simple English. So if you are curious, I would highly recommend that video. But basically, remember with the basis trade, which we found out the Cayman Islands alone is running a $1.2 trillion basis trade. The way that works is you are long the cash treasury, the underlying cash treasury. Here we can proxy that with TLT, which is the long bond ETF, and you are short the futures contract because there is a bit of kind of embedded premium in the futures contract that ends up dissipating toward expiration. So what they do is they lever that up. It's only about 10 basis points of profit, but if you lever it up 50 to 1, 100 to 1, you can make real money. And of course, what happened when the basis trade unwound is if you're short the futures contract and long the US Treasury, how do you exit that trade? Well, the way you exit that trade, TradingView is starting to apparently glitch on me, but the way you exit that trade is to, of course, sell the US Treasury and buy back the futures contract. And so what ended up happening is there was a significant dislocation of about 4%. The treasuries were getting sold to such a degree that the treasury was down 4% relative to the long bond futures contract. Now, again, they should be relatively right in line with each other, but because the basis trade got unwound in March of 2020, there was an extreme amount of downward pressure on the cash treasury, the long side of the trade, that leg, and there was a significant buying back of the short futures contract. So that's why you got the dislocation that we had seen before TradingView decided to glitch. Now we know the $1.2 trillion basis trade in the Cayman Islands. If that were to unwind, what we would see is a similar dislocation between the treasury bond future and the actual treasury bond itself. You can proxy that with various ETFs to get a sense of the relative change. So far, we are not seeing that. By the way, the Fed's meeting today, I would highly, I really expect them to end QT. We already know the pace of QT has been slowing because they normally do not comment on SOFR. They normally do not comment on repo markets. This is normally a very boring, very nerdy sort of part of the financial system that the Fed doesn't comment on. But Jerome Powell himself last week just commented on the elevated SOFR spreads, as we can see, which have been moving higher for 2 months now. Everyone on FinTwit is finally talking about this. If you've been watching the channel, you got a 2-month head start when we first flagged this possibility or probability, rather, a couple months ago. So kudos to you. Appreciate the support. Anyways, if the Fed is going to end quantitative tightening, it becomes a question of, do they restart QE? That is really the question. I think it's pretty safe to say they're going to end quantitative tightening, which is balance sheet reduction. Whether or not they announce maybe in the future some amount of kind of hint at restarting QE, that could be a boost. That is really the way to solve this problem. Jerome Powell specifically said he does not want to see a repeat of the basis trade unwind back in 2020. And of course, TradingView is not cooperating anymore. But again, that is where you get a spike in treasury yields because the bond is getting sold and a relative outperformance of the futures contract. Jerome Powell specifically mentioned that back that 2019 repo rate crisis and said that he would like to avoid that. And again, it is undeniable at this point we are in some amount of a crisis. The early stage maybe it is not blowing out 900 basis points like we saw in 2019, but there is definitely some significant stress in the overnight lending markets, in the repo market. And as we can see, again, the highest level going all the way back to March of 2020. Remember, that basis trade must be financed in the repo market. So you start getting dislocations in SOFR and that funding element of the basis trade, and it could cause serious problems. So anyways, I expect an end to QT, maybe even a hint at restarting QE. That is really the only way to address this, increasing bank reserves. Anyways, hopefully that was helpful, and I will catch you in the next one.